everyone. My name is Cody Clark with Clark Custom Homes, and today I have our first guest, Rick Wegmann with the Wegmann team. He is our preferred lender. Rick, do you want to take it from here?
Yeah, definitely. I guess I would say one of your preferred lenders. We're with New American Funding, and we were told that we are the #1 construction team in the nation for New American Funding, and we're in your backyard.
Yeah, that's awesome. So I get a lot of questions about what is a construction loan? How does it differ from a regular loan? Can you tell us about what's the difference?
What makes it a construction loan? Well, obviously everybody's wanting to have a mortgage, right? Or not everybody's wanting to have a mortgage, but if they're looking to build a home, they're going to have a mortgage at the end when it's all said and done. The construction part of that is just the payment for the vertical, and you can do it one of two ways: a one-time close and a two-time close. So you have your construction period, usually 6, 9, and 12-month periods, and it funds the process from start to finish throughout draws. And you, as the builder, you dictate how many draws you would like to see. Some builders like a weekly draw, a monthly draw, whatever it is, because of how they like to build their homes. So you just have that construction portion of it. Once the loan gets modified with a one-time close for free at the end, or you get a regular loan, like a Fannie Mae, Freddie Mac conventional, FHA, VA, whatever, it's literally like every other mortgage. So it's not really different. We're just adding a construction portion in the beginning to help you fund what you're doing.
Okay, that makes sense. If there's other builders watching this, we take a 10% draw
in the beginning
up front, which kind of gets us going, right?
Correct. Yep.
Which is opposite the way we used to do it. You don't take any draw, then you're funding the thing throughout the builds.
Correct. You're playing catch up with taking the closing draw, which is just for the things that you're going to do immediately, which is permits, porta potties, ordering the lumber package. So we'll get a portion of that kind of taken care of. It will do for architectural design. It could be paying for realtor commissions. So somebody helped bring the client to you, do the land, and a vast of other items in that initial closing draw.
So a big question, oddly enough, I'm a builder, but people ask me like I'm a loan officer.
Yeah.
All the time, ask our sales teams. So how much cash do you need to close?
So it usually depends. We obviously have clients of all different points in their life or acquisition of lands or whatever it may be. But when they come to you and they're asking these types of questions, they're either seriously looking for a builder because they already own the land. But let's say they don't own the land, they need to find that piece of property with that client. Now, you can acquire the land by a lot loan or pay cash, right? Which is obviously one way to buy land. So the cash to close for a regular loan is 5% for conventional, 0% for VA and USDA, and 3.5% for an FHA loan. So at the end of the day, for a construction loan, for us, that's all. You just need that percentage of the entire build, and that means the land purchase and the build purchase, if that makes sense. Okay. So you can, in a one-time close, construction loan, purchase the land at the same time. So you don't have to acquire it before. So if you want to buy the land and fund for Clark Custom Homes to build the home, 5%, 3.5%, or nothing.
Oh, wow.
Yep.
Okay. And so nothing is
VA and USDA, yeah.
And USDA.
Yeah.
Okay. Are there specific qualifications? Because that's our thing is rural luxury. So we do a lot of rural stuff. Would everybody fall into the USDA loan?
No. So oddly enough, there are loans that are essentially curated for different build costs or loan costs, and then different down payments and credit scores. So conventional is and has been historically the loan that you secure to do any type of build.
Okay.
But lenders like myself here at New American Funding, 3.5% for an FHA. Why would somebody do that? One, obviously to have less of a down payment, but then subsequently a lower credit score. So for us, under 680, you're going FHA.
Okay.
Most other banks, they only do conventional, but since we do FHA, we'll go down to 620, even 580 on a construction loan.
Oh, wow.
But on a VA and USDA, you have lower credit scores as well, but VA doesn't have a debt to income ratio cap. Weirdly enough, people don't know that. There's a lot of calculations when it goes for veteran. It can be dangerous, but it's a huge benefit. So there's a loan cap for a conventional loan. Let's say I think it's $832,750 right now is the cap for a conventional loan. VA doesn't have that. So we can do $1.2 million home going VA all day long, no down payment.
Oh, wow.
Now on a USDA loan, you're like, why would we not do USDA? I hear USDA loans are amazing. They can be amazing. There's an income cap and a debt to income ratio cap. So conventional loan, 49.99% debt to income ratio. So that is all of your current debt, the proposed housing debt versus your income. Okay?
Okay.
49.99. FHA, 56.99. VA, nothing. And you're like, okay, what's going on with USDA? This has got to be amazing, right? Wrong. 41%.
Oh, wow.
With maybe a chance to go a smidge higher, manually underwriting, but 41. That cuts out everybody. So we've capped them on income and we've capped them on debt to income ratio. It's really hard. But if you can qualify for that loan, it's an amazing loan. And we are in a rural area, so USDA eligibility for land is everywhere.
We have a lot of people that come in, and of course they want to build. And so at what point do you recommend that they start looking at the loan? Like, I know what we recommend.
Yeah.
That would be obviously, let's start early. So what do you recommend? Like, at what point should they start talking to you?
I think that if anybody is seriously considering buying land and maybe building on down the road, it could be 10 years from now, right? Or they already have the land and they're looking for builders or shopping builders. I think you start the process at that point. So when you have that idea, give us a call, help us game plan. Even if you think you may just want to pay cash for the entire thing, having a real conversation with a team that understands construction loans and literally every aspect of that is insanely important, because you can get somebody, and I hear this all the time, they go, I'm going to pay cash for the entire build. And you love cash clients. Every builder does. But here's the thing is, they go, I'm going to build $1 million home. Okay, that's nice. And then they get 6 months in, they're like, hey, can we get lending on this? I'm starting to run thin on cash.
Yep.
And you don't think about that at first, but then when you've shelled out $500,000 for this project, you're like, I should get financing. Here's the problem. Project's already begun. We don't have a certificate of occupancy. You can't get lending.
Yep.
You're stuck. So here's the thing is this. With us as a team, we'll advise you, hey, I know you want $1 million. You have the cash to do it. Let's finance half of it. That's okay. And then down at the end, when we go to modify the loan on a one-time close, if you want to put another $250,000 down and only have a $250,000 loan, let's do that. Because if you have that type of cash sitting in your bank or liquid, you know how amazing cash can be for investments. And so you don't want to tie all of your investment cash in a home. Play with it a little bit. Make more money with your money.
So obviously you guys offer two types of loans.
Yeah.
One time and two time. I always try to explain it to clients, but maybe you could do a better job than me, obviously. And so tell everybody, like, what's the difference between a one time and a two time?
Let's go back in the history of it a bit. So two-time close was the product that everyone did. It was where you would close with the builder and fund the project. You would qualify the borrower, make sure they could afford it. But then at the end, once the construction was done, you do your regular mortgage closing, right? And so you can go out and shop lenders. So if you're doing a two-time close and you do it with somebody who's offering that, they can do the beginning with you. But at the end, you don't have to stay with that lender. You can go and shop this with anyone. But here's the problem with that inherently, is you qualified in the beginning, but let's say in the middle, you changed jobs, or you got laid off, or you wanted to buy a boat, or whatever, and your debt to income ratio was close. When that thing comes at the end, you gotta requalify.
Really?
Now we got a problem.
Okay.
Maybe you spent all your cash.
Yeah.
Maybe health concerns popped in. Now the issue is, I can't qualify to get this home. What am I gonna do? Do I lose the home? Some crazy stuff starts happening, right? So here it comes in. One-time close, conventional, that was the product, been for a long time. Obviously other things have been added, but one-time close, 720 credit score, good assets, they qualify easily. We close it up front. We lock the permanent rate, let's just say it's 6.5%. And we tell you, hey, at the end, if interest rates have fallen, when you go to modify this loan from a construction to a permanent loan, we'll lower the rate for free. But we already closed you. You already qualified. When we modify this to a permanent mortgage, I'm not asking for bank statements, assets. I'm going, what do you want your rate to be? Do you want to put more cash down? Okay, cool. It's a conventional loan. Your rate dropped to 5.5% or 5%. Thank you, have a good day. And then they're done. They don't have that stress of having to make sure they qualify. I can't tell you how many times I've had a client go in and go, Rick, something changed. I'm like, we're okay. We already qualified. You're good.
That's awesome.
And so that's a huge benefit for a one-time versus a two-time. Not only that, two-time close, 2 sets of closing costs. Even if the lender goes, oh, we're not going to charge you that, The title company is, because the title company doesn't work for free, right?
Yes.
So 1 time, less cost.
Okay.
2 time, double the cost, even if the lender's not going to charge an origination, which is fine because you got title fees and another appraisal, another credit check, all of the things on a 2 time. So 1 time, in my opinion, more often than not, is superior product.
When clients do a one-time close, how does the appraisal process work? When does it happen?
An appraisal in any real estate transaction is the opinion of an appraiser who is licensed, obviously, to do what they do, but it's just their opinion. So you can have a different appraisal value for the same home at the same time for 2 different appraisers. It just happens, right? Just because how they are, their opinion. So we do the appraisal after we have a purchase contract from you, after we have a line item budget from you, and after we have architectural plans. I like to get a construction summary, so I take the plans and your bid, right? And we figure out what are you using in the build? What kind of countertops? What kind of flooring? What's the outside going to be constructed of? All of these things. Why? Because that is going to separate this house and explain to the appraiser as to what is going on. So once you have those things, the application's in, we've triggered the loan for disclosures, we're going to order the appraisal. So we send it to an AMC, an appraisal management company, so we can't be directly influencing the appraiser. The appraiser goes out, looks at the lot, checks the plans, looks at the construction specification summary that we've provided to them, and then they start looking at comps in the area that would be similar to what you have. So the more unique the home, the more remote the home, the less comparables that you're going to have. So I had a client in Oklahoma building a home way off in the middle of nowhere, right? It hadn't built up yet. Appraisal came in low. Why? It's an extremely nice build, but there were no comps.
Gotcha.
So the only comps they had were of lesser quality. That's hard to justify. But if you're building, let's say, in around the Metroplex, it is going to be pretty easy to get comps. And so for us, especially lately, because we have taken the time to teach the appraiser or give them more information, appraisals are coming in higher over what you are saying the house is going to cost to construct and the lot.
Probably the most common question that we get is, I want to build a house and a shop and a pool. Can we wrap that all up in one loan? Is that possible?
Most definitely. But
Okay.
the more things that you add, like we mentioned on the appraisal side of things, the more unique the property becomes and the more difficult it becomes to appraise. But yes, you can literally finance all of that. And I encourage that. If we can do that and we're under the loan limit, right? Or you have the cash to make up the difference if it's a $2 million home, right? Then I want you to do that. It's going to be a hell of a lot easier. To go further than that, a lot of people don't think of this. Hey, I want to get out on the land pretty quick. I'll just live in an RV, right? And they'll do that because that's common. But how about you build your shop with an apartment in it, do that first because it's inexpensive,
Okay.
move into that, and then now they're on site living in their little 800-foot, 1,000-foot square foot apartment in this 50 by 50 shop, then build the home, the pool, and all the other things. You can do that. But something unique that we do to not require somebody to do that is if you own your home currently and you want to build another home, if we go the conventional route, you don't have to sell that current home to build your dream home, right? As long as you plan to sell the current home before the completion of the new one.
Okay.
So a lot of people, they can't build that new home because they can't float 2 housing payments.
Yes. Okay. Yep.
Yeah. And so we don't have to do that. So we're allowing you to move once. And that's a huge change from what the industry is doing as a whole. They're making people sell, move into an RV, do the apartment thing like I talked about.
Yep.
And I give you guys that idea out there that don't offer the ability to stay in your home. But they get to stay in their home, put it on the market after 6 months after closing with their realtor, and then it sells, and then they move into their home that you've completed. And now it's smooth. So
That's awesome. Another hot topic is interest rates.
okay,
I'm
yeah.
not going to hold you to anything,
Oh, come on.
but I might.
Yeah, no, it's okay. It's okay.
So what are the interest rates doing? Are they coming down? Are they going up?
So what people more often than not don't realize is how tied interest rates are to the market, right? So interest rates for any mortgage, not just construction loans, are tied to mortgage-backed securities, which we saw a huge announcement come from Donald Trump, the current president, on that topic, right? And of them purchasing however many that has a little effect on interest rates. You have the overall market sentiment, you have the jobless reports, so how is the economy doing, like how are jobs going? All of these other things can affect what mortgage rates are going to do, up or down. They're volatile. They'll change every day, guaranteed.
Okay.
They'll change multiple times a day depending on how crazy the market gets. So why is that doing a construction loan beneficial, especially at one time with a free float down? Let's say we lock you at 6.5% today.
Okay.
And at the end of it, the overall economy absolutely was on fire. We're doing some crazy great things, right? The economy's booming. Interest rates dropped to 5.5% or 5%. You're floating down for free. So you're locking at the worst, potentially, right?
Sure.
With a promise to go down, hopefully. But let's just say it's a dumpster fire. Economy goes crazy. We locked you at 6.5, right? Now rates are 10%. You close up front, you're at 6.5. So you've protected yourself. So yes, interest rates go up and go down, but what doesn't change is the fact that land and construction always increases. The land will always go up in value. The home will always get more expensive to build, always. So if you start now and close it, no matter what the interest rate is, you're building your dream home, you're going to refinance later, even 4% or whatever the rate's going to be. So interest rates are a concern, but they shouldn't be the biggest concern, to be honest.
I have a client currently. They have a 3.5% interest rate right now.
Okay.
They don't want to build because they said the interest rate's 6.5. Is there any way for them to buy down that rate or get a better rate on their new build? Because they want to move, but they've got this great rate.
So what you told me is, based on the rate, that they bought before the market went crazy.
Yes.
So that house that was $300,000 is now $600,000.
Absolutely.
They got that equity. What a lot of people don't realize is, yes, you can buy down the interest rate, but buying points is what we call it in our space, is tax deductible. So if you itemize your taxes, you can write off buying down those points on your tax return.
Wow.
So you can pay a ton of money if you want to buy down the rate. Go ahead if you want to, but we can get them back down to a rate like that. They're just going to pay for it. And you just have to make sure that if you are going to pay points, that you stay in that loan long enough to see a return on that investment.
Okay.
Whatever it costs. If it costs 10 grand, if it takes 36 months to start making money from that investment, just make sure you stay in that loan longer than that.
Okay.
And if rates are lower at that time, refinance then if you want, and then buy down some more. Just make sure when you do it, that you're staying in long enough to see a return. Otherwise, all of that money was a waste.
Okay, that makes sense.
But talk to your CPA about taxes. I'm not a tax professional, giving a little bit of guidance.
Hopefully Rick has answered some of your questions today. If this was helpful, we will send you out a First Steps email. So click below and we'll get that out to you. And Rick's information will be in there. We look forward to hearing from you.